All right. We have a special guest, Peter Catalano, today. He is our wealth advisor. And
Woohoo.
what we are going to talk about today is, have you been laid off? Like, the economy's kind of yucky this year, we'll just say. I know a whole bunch of people who are getting laid off with the oil and gas, and it seems like it's a rough year with all the tariffs and stuff going on. So we're going to talk about what happens when you get laid off.
Awesome. Yeah. What happens when you get laid off? Well, you've got a lot of options, right? You first of all, you're going to get a packet from your HR, and depending on who you've been with and how long you've been with them, you're probably going to have a couple different sources of income, or a couple different sources of assets, is better said, that you'll have to deal with. One of them is just going to be your standard 401k.
Yes.
And what do we do with the 401k? Well, the easy answer there is roll it over into an IRA. Pretty simple. And work with a investment advisor. You can work with me if you like. We can open up an IRA, transfer the assets simple and easy into the IRA. And Kristin, let's remind everybody, is there a taxable event if we just roll over an IRA or roll over 401k to an IRA?
If you're doing a rollover, there is no taxable event, and you have
Perfect. And
60
that
days to roll it over.
you're not taking constructive receipt of the money. So if you don't take constructive receipt, we're good. I would recommend that you not take a check and then deposit it. There's your 60-day rule. I would recommend that you just take what I do with my clients is I have them go from the 401k directly into the IRA where you're not getting any incidents of ownership. So just
Yes.
as an FYI. But Kristin, we've run across this, and you had mentioned this recently. You ran across somebody who's recently retired. They got a loan on their 401k. How is that
Yeah.
treated?
Well, and technically they didn't retire, like they were laid off, but they recently took a loan out in the last year on their 401k and they haven't paid it off yet. Don't know how big it is, don't know, it's not my concern
Perfect.
yet. But if you cannot pay that loan back, you're going to have to, it's going to be considered a distribution to you and you're going to have to pay taxes on it. And one, it's going to get added to your tax bracket. So say you took out a $25,000 loan. I think you could take up to 50,000. Say you took out a $50,000 loan and you're not able to repay it back and now you're laid off or you're retired. That $50,000 gets added to your income in the year that if you get laid off this year, it's going to add it to this year's income. And then the other kicker is, say you're not 59 and a half years old yet, like you're younger than 59 and a half, you're young. So one, it gets added to your income, but then you're also going to have a 10% tax penalty on it.
Early withdrawal, right?
Really, really, really sucks. I do not recommend it. Pay it back if you can. It will hurt you on tax time.
Well, I think this brings up a couple things. So glad you educated us on this. The thing I like to bring to my clients right away is, do we need to take the loan out of the 401k right from the beginning? So what's the issue that we had to go to a 401k to borrow money out of the 401k? Is it a cash flow issue that we didn't manage? There's 5 areas to financial advising, cash flow being one of them. So is there a cash flow issue that's going on? Is there an emergency issue? Do we not have 3 to 6 months of emergency funds in place that could have covered this unexpected expense? Or did you want to just buy a house and you wanted to borrow money out of the 401k to buy the house, which I totally get. But just understand there are implications to borrowing money from a 401k. And if you retire or you leave the job voluntarily or involuntarily, you may have a taxable event here, and make sure we
Mhm.
have enough money to cover to pay back that loan so it's not a distribution. That's amazing. What are some of the other things that come up? Some people want to build a business, and I know you've used this, and you've
Yes.
talked about some clients who've used this. You know where I'm going to go with this one, right?
Yes.
Using your 401k to run a business. It's robbed, right?
Yeah. So it's called a ROBS, ROBS, and it stands for Rollover Business Startup. So if
Mhm.
you do have money sitting in your 401k and say you got let go or you're doing an early retirement and you do like, you know what, I'm not really retired, ready to retire, to want to do something else, and you have a really good business idea that you know is going to make money, that's the key, then we can start up a ROBS for you. You can roll over your old 401k into a new one and you can use that as seed money to get it started. However, There is a lot to consider when you're thinking about
Sure.
that. So it definitely needs to have a conversation if you even want to go that route.
Yeah, I've worked with clients in the past who have used their 401k, rolled it into a Robs, and it was not a pleasant experience
Yeah,
for
if the
them.
business doesn't do well, your 401k is gone. Like, or if it doesn't sell, like a lot of times, I know there's companies out there that really sell the ROBs and they sell them with like franchise, like let's open up a franchise restaurant. Restaurants are so risky. And I've seen clients where they had to shut down their restaurant because it wasn't doing well and they did a ROBs and now their retirement's gone. Um,
Yeah.
so
I
it's
think that brings up the point that you really want to have a plan in place.
yes.
And I think if you are in the category of, hey, I'm not done yet, sure, I'm leaving this company, but I'm ready to do something new and different, great. But let's still put a plan together. Let's look at all the assets. If you are going to create a business, let's make it a viable business, not just some kind of a whim of an idea, right? That I think is
Mhm.
going to sell a million or whatever, a million widgets. Let's put a plan together so we don't lose
Yeah,
everything. Now you're really starting.
exactly. Yeah.
Plus, correct me if I'm wrong, this is year end. I don't get into this, but Rob's is relatively costly. I mean, it's opening up a C Corp, it's open,
Yep.
you got a lot of accounting, a lot of
Yeah.
filing, a lot of reporting.
Yeah, there's a lot of compliance that goes with it. Like it's its own business and you have to treat it like its own business. A lot of times, entrepreneurs they kind of commingle things and they're writing off their dead uncle and who died a couple years ago and the boat that they need to take clients out on. There's none of that funny business that happens in a C corp. There's a lot of compliance, minutes that have to take place. And then with the 401k side, there's an extra form, a 5500 that needs to be filled out every year. So it's not always the answer that everyone's selling you. And again, that's why it's so important to have that conversation ahead of time. And the other thing is with the majority of the other businesses, they're called they pass through. They're pass through entities. So they pass through to
Mhm,
you personally, and you personally pay the taxes on them, whatever tax bracket you're in, 10% up
mhm,
to what is it, 32, 37%, whatever it is now.
mhm,
With the corporate taxes, you pay a flat rate, no matter if you made $1 or 100,000 or 1 million, you're paying a flat rate of 21%
mhm.
on your
Amazing.
income.
It's something really to look at. I think it's a
It
good
is.
option, but put it on the table and evaluate it to look at what makes sense for you. Let's come back to the kind of the basic. I've been working here for 30 years. I'm done. I'm 60, 65. I'm ready to,
Ready to
hit the
retire.
links, do the traveling. I don't want to do another business. We talked about the 401k. More than likely, you've got one of those. You'll just simply roll it over. It's actually very simple. You've also got pension. I see
Yeah.
this quite frequently, right? You'll get, you'll receive the packet again from HR, and it'll be, oh, I can take this, pension option as well, which comes in forms typically of an annuity. If you really look at it, annuity defined as a stream of income. And so they give you this option. Hey, you've got, 500 grand in this pension. You can take a life, you can take a lump sum, you can take a life period certain, you can take a life and 50 to spouse, you can take a life and 100 to spouse, and there's a bazillion other ways that you can take this thing. And it's like confusing to a lot of
Overwhelming.
people. Oh, it's just ridiculous. So, those are the things we look at. We look at the 401k. We can treat the pension rollover the same way. We can basically roll this over, put it into an IRA, and control the distribution according to what you like. And that's really, I think, the key is how do you want to control how the distributions are made and to whom this money is going to be left. And if you take the pension option at work, you're going to be locked into that and may be perfect for you. If you take a rollover option and then choose a annuity to take distribution, that may work too. Simple answer there is who's going to give you the best payout, who's going to give you the most control, and who's going to net most money not only for you, but your spouse and or legacy and generations. And that's what I look at in taking these distributions. We got not only your income, but we have legacy as well. Where do taxes fall into a lot of this? Where do you find these conversations when people come to you like this, Kristen?
Um, so a lot of the times, like I'm just getting the pieces of paper at the end of the year that say how much money they had in their pension or their 401k. And depending on pensions are taxable. Um, if it was in their 401k and it was a Roth side of things, it's it's grown tax free and there's no taxes on it, which is great, but it
Hmm.
all depends on how it was set up to begin with. So a
Sure.
lot of times I I'm not involved with it. Like I just get the information at the end of the year, but I think it'd be really great for my clients when they're thinking getting close to retirement and they have these options to be able to go sit down with someone like you who can literally explain to them, here's option A, B, C, D, E, and here's the different outcomes. Like, and being
Yep.
able to sit down and see exactly, okay, so if I die, it will go to my wife for the next 15, 20 years, or if I die, it doesn't go to my wife, or just all those different things. Or I should say spouse. Um,
Hmm.
because
Well,
I
I
have
think the
husband.
key, I think the key here that you bring up, which is excellent, you get paperwork typically in, February, March, April for
Mhm.
events that occurred last year. And
Exactly.
folks, please remember 12/31, December 31st is a deadline.
Yep.
So a lot of times you can avail yourself to different options if you take action prior to the 31st of December. Once the 31st of December hits, usually you've already made that decision or
Exactly.
decision's been made for you. So that's, Kristen, what I'm hearing you say is let's go through and when the event occurs, when you get the packet, when you get the notification from your company, um, engage me, engage you. We work together. This is collaborative planning work where I can come to you and say, Kristen, here are our options. Here's what the client's looking to accomplish. What are our tax implications under these different options?
Yeah.
And vice versa, right? You can come to me and say, okay, Pete, how can we move this money and do here because the client's choosing, these tax options. And really, folks, it's the planning and the collaboration that makes sense. Now,
Yeah.
one person we don't have on this call, and one of these days we will, folks, is we'll have the attorney on the call. Because again, if you're at that age where you are retiring, where you're going to be hitting the links or doing the traveling or seeing the grandkids, whatever the case may be, we also need to make sure your estate is in order. And
Yes.
estate planning, distribution planning is a key element that coincides with the accounting and the planning, the financial planning and investment management. So all of us need to come together for you, Mr. and Miss Client, so that you're going to get what you want, minimize tax, maximize income.
Exactly.
That's the goal. So, Christian, this has been another great few minutes here with you today, folks. If you're entering into a retirement phase, voluntary or involuntary, especially if you're here in the greater Houston area, we'd love an opportunity to talk to you. I know that between Kristen and I, we're more than happy to sit down with you, do a Zoom call, do an in-person call. I'm up in the Woodlands, Kristen's out in the Waller area, and we have cars we can travel. Uh, we can come and sit down with you. We want you to build the best thing for you. And planning without just a bent one way or another is really the way to go. What do you think,
Exactly.
Kristen?
Yeah, this was great. Thank you so much for taking the time to talk with me today, Pete. I always love these conversations, and
Me too.
planning is key. And um, clients, people, individuals, they need to stop being, waiting until after the fact. They need to start being proactive
Yeah,
and again, planning. But we can do so much for people who actually want to plan
yeah.
and avoid, not avoid, but minimize taxes,
Hmm.
set them up for a legacy. And
Hmm.
everything you said was just spot on. So again, thank you so much for the call today. And if this was interesting to you, you can go ahead and book that free discovery call with us. It's absolutely free, and we would love
Hmm.
to sit down and talk with you and see how we can help you. And again, go ahead
We
and
love it.
share this. Share, comment below. We want to get this across to as many people as we can. Thank you so much.